to US, they might have exposure to Western European markets, and now they're wondering what's next.
Have the highest tariffs in the US since the beginning of 20th century. I think our transaction is still priced better than the
Many private credit investors already have exposure to US, they might have exposure to Western European markets, and now they're wondering what's next? What else should I be looking at? What are your thoughts on that, Radek?
for having me again, Johanna. That's are very serious and valid considerations, and also investment professionals are thinking a similar way, like how to diversify away from the US, potentially from a broader developed market. If you look like what happens since the beginning of the year, a lot of things happen. That we have the highest tariffs in the US since the beginning of 20th century. And let's see if they come down after this Trump's visit and his talk with Mr. Xi. There was been pressure on Federal Reserve Bank to cut the interest rates faster, which created doubts among the investors about the independence policy making on the US dollar. And I think it contributed to the recent weakness of the US dollars, this exact thing. At the same time, developed market GDP growth since the beginning of the year is on annual rate 1.6%. Emerging market Europe 1.8%, a little bit higher. And emerging Asia is 5.2%, so it's way higher. Right? So it would indicate let's go there. China manufacturing is contracting. Japan manufacturing is contracting. India is expanding, and you have a surprisingly tight spread. So it means that the difference between the policy rate and the interest rate the corporates are paying in the US for the debt is surprisingly small. And a lot of people are asking, is that reflecting all the risk, what is happening in the economy? And a lot of it is happening at this moment. And all the assets are very expensive. Like there have been news that they are newly $4 trillion worth companies, right? It never have been such a precious company like in the world. A lot of $1 trillion worth companies are there. So my question is it really that these companies are so valuable and are so great, or is it mean that the asset prices are so high relatively when reflected in the US dollars? Because if you look at the gold price, now we are, as of today, last day of October is $4,026 per ounce. That's also relatively high.
Very high.
Price. That's a very high price, right? So if you look 10, 15 years back, right, that's very high. So it will be telling you that maybe the asset prices relative to gold might not be like that high, but because of the US dollar and what is happening, and we are expecting interest rates to go down, that usually helps the asset prices. And now the question, what to do as an investor, right, in this situation? Like again, what are the correlation and so on? And a lot of investors are finding the answer. We should invest more into the emerging markets. So emerging market funds are a good way to option emerging markets. Government bonds as well, because the debt is relatively doing well in the emerging markets. You need to be a little bit selective, like as well. Like some countries did very good. Some countries are not doing like so well. In Europe, we have an example that Poland is doing really well. Turkish economy is doing like really well, but the inflation there and also the political stability is a big question. In our backyard in Asia, the question mark we have about Indonesian economy, but the Vietnamese economy is doing so well. It has been recently upgraded to the emerging market. So you see that you have to be selective, and And that's what we are doing. We are very selective with our private credit strategy in the emerging markets. So we are investing in Poland. We are also invested in Kazakhstan. We are invested in Mongolia. We invested in Indonesia carefully with the largest and best players over there. And we'll continue investing in emerging markets, especially in Asia.
And can you share any ideas or thoughts on the markets that you're looking at more closely right now? What's next in the pipeline?
I think the hottest market is India, but India is such a large market with its own rules, so you need to play by the local rules, and we are learning how to play. We have 2 investments in India. We are very happy with them. We would like to add more. I think the 3rd one is coming really soon.
And another question, now I'm playing a little bit of devil's advocate, because one of the pushbacks that you could hear from investors looking at developing markets is to say that if you can get government bonds, for example, as kind of double-digit or low-teen returns, then what's the interest in getting access to our transactions, for example, at kind of low-teen, mid-teen? What would you answer to that?
Well, I think our transaction is still priced better than the government bonds. I would say we offer interesting upside to the investors with our deals. Semi-liquid strategy, not correlated that much with the overall markets. If you're going to invest in the government bonds, and perhaps you should, there's nothing bad in it, you are practically investing in a publicly traded instrument, which is going to have all the volatility related to the publicly traded instrument. So that's why we don't do that, because we have a private markets strategy. But yes, sure, like if you are an investor and want to diversify, you should also invest into the public government bonds.
Understood. But you get a different return structure then. With Kilde, you have fixed returns, government bonds, it's public markets, and slightly different return profile.
Sure, depends on the bond, depends on the everything depends on the bond, but you will get the volatility.
Understood. All right. Thank you very much.
You're welcome. Thank you for having me again.